Now it is my pleasure to introduce our presenter, Mr. Shailesh Kumar. Mr. Kumar is the head of Global Insights Center at the Hartford Financial Services Group, and we are very fortunate to have him share his expertise with us today. So please welcome Mr. Shailesh Kumar.
Thank you. Thanks for having me. I appreciate it. We're going to talk about the economy and specific focus in the construction sector, which I'll go into. If there's any questions, as mentioned, please feel free to ask them at the end. We have about an hour block. I think my comments will take maybe around 35, 40 minutes, something like that. And then any questions you have, we can go through them at the end to the best that I can answer them. So let's start off with what's going on right now with the state of the economy. And since it's the start of the year, 2026 is beginning, we're about 2 weeks into the year. I wanted to start off by recapping the major themes that we just went through in 2025 and what their impact was at a sentiment level, but also on a quantitative numerical level. We refer to these as economic influencers, and what they were tariffs was obviously the overriding topic of last year. Began really early in the year, but really began to gain momentum around April 2nd specifically, when the Liberation Day tariffs went into effect. There was a lot of market volatility that happened afterwards. That subsided eventually, but about a week later, the administration pulled back some of the tariffs and then slowly really began to re-implement them all over again. Federal Reserve was on hold for most of the year, but then in September, they began to cut again. So interest rates started to move lower slightly. The budget bill was a major theme that I'll talk about and its impact on the coming year. The AI spending, the growth of AI, the role of AI in financial markets, and then obviously some of the vulnerabilities that people are now talking about. And then finally, the government shutdown. Those are not all, but some of the major themes that drove economic outcomes. And one of the things we've been observing, particularly in the post-COVID environment, is consumer sentiment is not great. This has been a theme that's been playing out for the last 5 or so years. And we look at this through the University of Michigan Consumer Sentiment Index, and it's been pretty consistently negative. Anything below that bar right there indicates pessimism. Anything above is confidence. And one of the things we are really interested in dissecting as a team is why is it that consumer sentiment is so weak yet, and as I'm going to talk to you about in a minute, yet despite that, the economy is doing pretty well and consumer spending is really strong. So people are saying they're not feeling great because of everything that's noted here in the influencer side, or some of them, but yet spending still holds up. And that's what we saw all throughout last year. So let's start off with inflation from more of the quantitative side. Inflation obviously is a very important topic when it comes to claims costs, when it comes to construction costs, when it comes to the cost of doing anything. There's headline inflation, which is the area in tan. That's the big number that we look at, consumer price index in this case. But then there's some sub numbers we look at and track really closely, like goods inflation, services inflation, food inflation, energy inflation, and then even within it, there's a bunch of other numbers we can look at. Headline inflation in the pre-COVID environment was running at around 2% or less. That was within the Fed's target. That was the sweet spot. Headline inflation for about 30 years was running around 2%. So we never really worried about inflation. It wasn't until COVID, when we had the supply chain disruptions, and headline inflation got up to 9.1%. It was there briefly, and then it started to normalize. And in fact, even last year, most of last year, inflation was improving. It got down to a low of 2.3%. So just to be clear about what we're talking about with inflation, though, when I look at inflation, when we look at this chart, when we look at the numbers, we are talking about the year-on-year rate of change of a basket of goods and services. So 2.3% implies that prices went up by 2.3% from the previous year. They still went up. And that's this big dichotomy about inflation. Everyone keeps saying in the media, well, when will prices go lower? And the reality is they're never going to go lower. Prices don't go down. That's called deflation. Prices will likely go up. What we want to always see in inflation is a more normalized rate of change. So 2% is the ideal number because the Fed, all of us want to see prices go up at a healthy 2% a year, give or take. When they start to go up by 3, 4, 5, 9%, that's a problem. So it's a really important statement or distinction to make that inflation will be here. Inflation in itself is not an issue. It's just how high of an inflation number are we dealing with? And again, that number came down to 2.3% early last year. And then towards the tail end of last year, so around August onward, it started to rise. And it finished the year officially at 2.7%. So not 2%, but not 9%. And to the question as to, well, why do people feel the way they do? Why do we keep hearing about the cost of living and the elevated prices in the grocery stores and everywhere else? How does that align with what I just said, that inflation numerically is normalized? It's because of the compounded effects of inflation. We are still dealing with that era from COVID when prices were rising 9% a year on year. That is still being felt. And that goes to my point again about prices are higher. They are, of course, higher than what they were before 2019. And that's what people feel. They don't think about inflation the way I do. They're not thinking about what was it last year. They're thinking about it on a broad-based basis. So both things can be true is my point. People can say, and people are correct to say that prices are significantly higher, but the headline rate came down to 2.3 and now it's at 2.7. Now the reason it started to swing up in Q4 of last year is because of this maroon line. The maroon line is goods inflation. Goods inflation pertains to anything you can wear, like clothing, washers, dryers, cars, appliances. That all constitutes goods inflation. If you look at this graph here, goods inflation up until COVID was zero, pretty much averaging, meaning that the price of goods were not really rising at all, which is pretty phenomenal. That was a byproduct of globalization. It's because we were importing a lot of really cheap stuff from around the world. During COVID, because of the supply chain breakdown, goods inflation got really high, got up to 12%, and then it came right back down again and was averaging around zero. In the last quarter of 25, but even a little bit before that, goods inflation started to rise, and right now it's around 1.4%. And the reason it started to rise is because of tariffs. Tariffs are a tax. It's a added cost of business, and I'll talk a little bit more about what specifically is happening with tariffs. But that's largely the reason why goods inflation went up, which caused overall inflation to bump higher as well. 1.4% is definitely more than zero, but it's way lower than 12. So I just want to put some balance into the statement by saying 1.4% is high. It's higher than what we've seen before, but it's not as high as what we saw during COVID. So tariffs are likely causing goods inflation to move higher, which in effect, in total, is causing overall inflation to also move higher into late last year. On the labor front, unemployment rate is at 4.4% right now. The all-time low is 3.5% right before COVID. Right after COVID, it was 3.5%. That was about a 60-year historical low. 4.4% unemployment does imply a weaker labor market. Obviously, it's higher. We were saying starting last March or April that we're likely to enter a period of a softer labor market, which is precisely what started to happen last year and which is what we think is going to happen this year as well. A softer labor market means that the labor market is not falling apart. It's not collapsing. There's not a wave of layoffs. It's just that the unemployment rate is rising. Demand for labor is softening, taking longer to find a job. Turnovers are slowing, all of that stuff. That's what a softer labor market is, which is what you see by this 4.4% unemployment number. At the same time, wage inflation, which is how much our salary is going up, is still above trend. Wages used to rise in the pre-COVID environment by 2.5%, 3% at most. Right now, wages are rising by 3.8% year on year. So even if people don't feel it, they on average are getting a 3.8% increase in their salaries, which is otherwise a good thing if you're getting it. And then if you're paying it, obviously that's a cost of doing business. So there's this inherent flaw in this statement that I just said, which is on one hand, the labor market is softening. And we also see it here in this data set, which shows how many jobs are being added. In the up until last year, the U.S. economy was adding about 160,000 jobs a month. That in the last few months came down to about 12,000. So the pace of job formations and job additions has come down. So again, there's a little inherent flaw here theoretically in my statement when I say that the labor market is softening, the unemployment rate is rising, the amount of job formations is coming down, yet at the same time, wages are rising at an above trend basis. And both things are true in this example, in this instance, because of the lack of labor availability. So one of the factors I'm going to talk about in a little bit is demographics, but because of the shortage of labor in certain pockets of the economy, even though the labor market softens, their wages are going higher because it's harder to find the right talent. So both things are true in this environment at this moment. Interest rates, as I mentioned, the Fed was on hold for most of last year, and then they started cutting in September. If we think back on a broader basis of what happened, when COVID occurred, the Fed cut rates to zero. Then when inflation spiked, which I spoke about, the Fed raised rates to 5.5%. And then in 2024, when inflation started to improve, the Fed began to cut. And then they stopped early in 2025. And the reason the Fed stopped in early 25 was because of tariffs. Fed was worried about what happens if tariffs cause inflation to move significantly higher. The Fed did not want to be seen doing is cutting interest rates just as inflation was moving higher, because the Fed has a dual mandate. They have to target inflation and they have to target labor market. So the Fed was on hold. And then in September of 25, the Fed began to reinitiate rate cuts. But the reason wasn't because they were convinced tariffs and inflation weren't a problem. That's still lingering. The reason the Fed began to cut in September is because they concluded that the weakness in the labor market, which I just spoke about, is more important now to deal with. So that's one of the real reasons why the Fed started to cut in September. So our outlook is that by the end of this year, the Fed will likely reduce interest rates to 3.25% by the end of the year. So just to put that number in context, there was at 5.5 right after COVID, and we think it'll go down to 3.25 by the end of this year. And that would put it not at the lowest, but somewhere in the middle or closer to the higher end of the 40-year average. And that's normal. One of the things we often talk about is the era of 0% interest rates was distortive. It likely did cause some distortions in the economy. And what the Fed is trying to do is thread a needle of reduce interest rates, but not take them so low that it causes some distortions in the long run as well. Here's overall GDP. This is on a quarterly basis annualized out. So this is how much the economy is growing. Pre-COVID environment, growing at 2+% was really healthy, and that's what we were doing. Post-COVID, the US economy was expanding between 2 and 3%. This past year has been really fascinating. So in Q1 of this year, of 2025, in Q1 of 2025, which you see here when it says March of 25, the US economy contracted by 0.6%. That's obviously not a very good outcome. If you get two contractions in a row, that's called a recession. So we had a negative 0.6% growth in the first quarter. In the second quarter, economic growth rebounded to 3.8. And in the third quarter, it grew even faster to 4.3%, which is really quite stunning because for the US economy to grow by 4+% is pretty impressive. But just to take a look at, well, why did that happen? Why did we have this sharp contraction at the beginning of 25, followed by this expansion thereafter? We got to break down what drives GDP. And this is the first thing you learn in economics, which is the four moving parts to GDP. One of them is consumer spending. The second is business spending. The third is government spending. And the fourth is net trade. And what I have here is a bar chart breaking down all four of those drivers of economic growth. And if you look again at this March 2025 number, when the economy contracted by 0.6%, the thing that should stand out is this pink bar. That's trade, net trade. And it's really quite sharply negative, which is what dragged the entire economy down. The reason it was so negative in March of 2025 is because businesses were aware tariffs were on the way, and they wanted to get ahead of them by importing before those tax rates hit, before those tariff rates hit. So in the first quarter of 2025, we saw a surge of imports, which drove the trade deficit to a record high. From a GDP calculation, that's a headwind, that's a negative. It takes away from growth. That's why that pink bar is so negative there, and that's why the economy contracted in the first quarter. By the time you get to the second quarter, though, the trade story went and flipped and normalized. All the businesses had already imported as much as they needed to, so trade became a tailwind suddenly, and the economy grew. And same thing is true in the third quarter. So you can see how the pink bar goes from negative to positive across the year. But the thing that should really stand out is this brown part of the bar. That represents consumer spending. And from March to June to September, so Q1, Q2 to Q3, you can see that the consumer spending number grew each quarter. And that's really quite surprising and goes back to the comments I made earlier, which is that even though people are negative and they're pessimistic and they feel that the economy is not doing well, consumer spending is really holding up quite well. And Americans are out there spending. So then the question is, well, why is that happening? Why is consumer spending doing so well? One of the theories we have is it's linked to equity and home market performance. Equity markets have been doing really well. And what we've calculated is that the equity market performance and the rise in home equity valuations has delivered a cumulative $57.5 trillion of added household net worth over the last 5 years, which in turn has translated to an additional $2.6 trillion of spending beyond what spending would have otherwise been. So the logic is the following. If you own stock and you have a portfolio and you have a 401k and you look at it and it's doing well, then that gives what we call a wealth effect. Even if you're not liquidating any of it, it does free up space from a psychological perspective for Americans to go out and consume because they believe the safety net is stronger. If their home equity valuations are stronger, even if they're not selling their homes, does give them the psychological boost. And so that's the calculation we put together, and we believe that it has driven additional spending. But the reality is that the spending is not uniform. The growth in spending is likely occurring in the more affluent households, those who have stock, those who have accreted value in their homes. That's where we believe a lot of the additional spending which is driving the economy right now, is taking place. And that's, again, what you see here on the left side. The right side is showing you household savings rates. So Americans used to save 5 to 6% of their paychecks before COVID. During COVID, savings rates were really high because nobody was going anywhere. Now that number is running at around 4%. So Americans are saving less today. So to go back to the point, the wealth effect, equity markets do well, portfolio positions are stronger. They're not liquidating it, but they are drawing down their savings in some cases to spend more because they feel comfortable about it. Some families are taking on more debt. Household debt levels have in fact increased. So depletion of savings, higher debt levels, but this is sustaining the consumer story. So a lot of it does go back to how equity markets are performing, and that there's a huge correlation there that's playing out. So everything I've talked about is at the macro level. When we think about 2026 and what our outlook is, we do believe that the economy is going to grow, continue to grow in 2026. We just don't think it's going to grow at the same rate as it did in 2025. Our statement last year at the start of the year was that economic growth in 25 would probably be positive. It would probably be strong, but it wouldn't be at the level of what we saw in 24, and that was true. That's pretty much what happened. And same thing with 2026. We believe economic growth will be positive. It just won't be at the level of what we saw last year. It's going to slow down a bit more. So that's at the macro level. We also want to be cognizant of state level economic dynamics are very different. So we've started to do a lot of work on our team about what's happening at different states from a macroeconomic side, from an industry growth side, labor side, immigration side, labor availability side, cost of wages, all of it. So we can depict more localized stories. And what you see here is that economic growth at a state level is quite different. States like Texas, Florida are doing really well. Certain states like North Dakota and Maine are not growing as well. So we just want to put this out there so everyone can understand that economic outcomes across the country do vary outside from what the national story is telling you. Now I want to pivot to AI and the economy, and I will build this all up to construction and what the effects are on construction specifically. So one of the theories or ideas we've put out there is this concept of the circular AI economy, because we get asked this question a lot about, well, is there a risk? Is there a vulnerability? And our answer is that before we can even talk about risks and vulnerabilities to AI, we have to first understand how AI is driving the economy, what its role in the economy is right now. And the way we've identified the story is, again, this circular AI economy. It starts at step one. Step one is AI R&D, research and development that leads to chip design. And specifically what I mean by this is all the companies in Silicon Valley that we've all heard of, the ones that are dominating the stock market right now, they're really good at designing chips. They don't make any of them. So they design the chips, they come up with the blueprints, and then you get to step two, which is the export of those designs to manufacturers, which are called fabrication facilities or fabs. And they're based in Taiwan, South Korea, Japan, and other markets. And TSMC is one of the most famous ones. So step two is the export of the designs. Step three then is those chips are manufactured in Taiwan predominantly and then imported into the US. Step four is those chips are taken and then they're put in these data centers, 4 cement walls with a ceiling and a lot of power. And those data centers then power the AI infrastructure. And then step five is corporate AI purchases, companies going out to other companies and saying, you need more faster processing, you need better AI computing. Other companies saying, yes, you're right, buying the software. And then they have more demand for faster computing, which leads back to step one of more advanced chip design. And we keep going in the circle, which is how the AI economy has evolved over the last 60 plus years. But at each one of these nodes, there's a risk factor. At step one is if capital market conditions change, if demand for the product and the software purchases changes, that might affect how quickly and aggressively some of these companies are building out these semiconductors. Step two is if there is a restriction in intellectual property exports, which could happen. And we're not saying it will, but just like the tariff story is restricting imports, we might also restrict the export of intellectual property. That's a risk factor to think about. When it comes to chip imports, one risk factor to think about is our over-reliance on certain manufacturing centers like Taiwan. There's the obvious geopolitical considerations, but there's also weather considerations of what happens if some of these facilities are knocked offline for some reason. The vulnerabilities in step four, the data center build out, is if there's a lack of construction labor availability, if the cost of construction goes up, if for some reason there's a decline in energy availability to power these centers. And the vulnerabilities in step four is if there's a belief out there that some of this is overdone, it's hype, and that the demand for some of these software purchases starts to slow down, which can then slow down everything. So again, this is how the AI economy works, and these risk factors we should just be aware of as potential areas that could upend this story. So that's how we're thinking about it. Now, if we get into what is the contribution of AI and tech to the overall economy, the question often comes up to us is the overall economy being driven only by AI and tech? And the answer is not really, kind of, but not really. AI and tech is the second biggest driver of economic growth right now. The first is healthcare. So healthcare accounted for 40% of Q3 economic growth. And AI and tech accounted for almost 25% of economic growth in Q3. So yes, it is a big driver of economic growth, but not the only driver. And when we think about the totality of GDP, how much of the US economy is made up by AI and tech, the answer is 7.7%. And again, a bigger number than that is healthcare. Healthcare makes up almost 20% of US GDP. So healthcare is definitely way bigger, but AI and tech is a second place. So it matters, but it's not the only thing that's driving the US economy right now. In terms of why and how does it drive the economy specifically, beyond what I mentioned earlier. The first is equipment purchases, which I alluded to, purchases of software and technology by companies, and that number is growing by 24% year on year. So there's a significant business expenditure component taking place right now. Businesses going on buying these software, which drives economic growth. And that's what you see on both these sides. Software spending is growing by 12%. So there is an actual business CapEx story at play here as they're absorbing artificial intelligence into their day-to-day operations. But the second has to do with the data center spending. And this is physical, tangible dollars going into building physical structures, all these data centers. And when you look at this chart, one of the fascinating things is that data centers are all over the country. So it's not like they're being concentrated heavily only in, yes, some states have more of them. Virginia has a lot, Texas has a lot, but the data center build out is occurring nationwide. And so that's money being deployed to build physical assets, and eventually also towns come around it or people need to work on it. There's a demand for labor, there's a demand for material, and all of that is really quite stimulative and has been stimulative for economic growth so far. One of the things that we think a lot about is the actual tangible dollars, as I mentioned, spent on data centers. And that number was rising by 90% year on year. Now it's growing by 30. So it's still a big number. But the amount of dollars that are being put into the ground to build these massive data centers is still growing quite rapidly. And we do expect that story to continue. The caveats being those risk factors I identified to the AI economy. If something happens in Taiwan, if something happens from a hype perspective, if something happens to the capital markets, then that number will slow. But for now, it continues to grow at a rapid rate. Data centers also require a ton of power and energy. And one of the things we've been observing, one of the data points we've been observing is that dollars spent for power and the energy construction has not been keeping pace with data center spending. So as I mentioned, dollars deployed in data centers was growing by 90% and now at 30%. Dollars deployed to power and energy construction are growing at like 0% right now. It's kind of flatlined. It's still, spending is happening. It's just the dollar growth isn't happening. So there's two parts to this. One is when we looked into the numbers, we found that a lot of the spending is being directed to renewables, which are cheaper forms of spending. They can still produce energy. It's just at a lower cost. So more gigawatts of power are reaching the grid, but you're just not seeing it reflected in the dollars. Another side to that is that a lot of the dollars being spent are for captive energy. So data centers are building some of their own power centers, which is not showing up in the broader data. It shows up in the data center data. So that's true. But we still do believe that a significant more amount of energy needs to hit the grid over the next decade. So our view is that power and energy is a massive growth area as the years go on. As these data centers start to build out, as they start to come online, as they start to need more and more power, we are likely to see increased demand for power. And so we look at this as an area of the construction vertical that's set to grow over the next decade. Now I want to talk about demographics. Demographics are critical for demand of product as well as the availability of labor, which is where I'm going to take this conversation. So when I look at this charts, what I have in front of you here is a bunch of charts that shows population of America over the different years. In the year 1980, I may have shared some of these with this audience in the past, but in the year 1980, the vast majority of America's population base was between the years of 20 and 30, so 20 and 30-year-olds. And if in the year 1980, if you were 20 and 30 years old, that means you were born between 1950 and 1960, which is the baby boomer generation. In a pre-AI era, this type of breakdown of society is really good because you have a lot of young people who are working and paying taxes and fewer people who are needing government benefits through those taxes. So it's an optimal economic outcome from a productivity and GDP standpoint. By the time you get to 2024, the breakdown of the US population starts to look a little bit more even. So people equivalently in their 30s, 40s, 50s, etc. And then when we project out to what's going to happen to the US population in the year 2060, these are our numbers, we find that we're going to start to become a lot more top heavy. So a lot more people in that 40, 50, and 60 age group, and fewer people in that 30 and younger age group. And there's reasons for this as to why we start to get this imbalanced, distortive distribution of ages where we're more top heavy, where our average age increases, where we have more people at the upper bands of the ages and fewer at the lower bands of the ages. And the reason for it is what's happening with birth rates in this country. So the left chart shows you overall population growth. In the 50s and 60s, our population in the US was growing by 2%. Then it slowed to 1%, and then it slowed to 0.5%. And we're on track to see it go down to 0 and then eventually negative. We have about 340 million people in the US today. We believe that number is going to go up and peak out at about 354 million over the next 25 years. And then starting in the year 2051, we forecast the US population is going to start to decline by that point in time. And as I said earlier, the big reason for that is the decline in birth rates. So you can see in the dark maroon line what's happening with birth rates. They've been coming down steadily over the years. The only other way to add human capital to a country is immigration. And you can see in this pink line what the immigration story was. This is both documented and undocumented. Both are here. Right now, immigration numbers have fallen to a multi-year low. Even in our projections, even if we take that number back up to what it was on an average pre-COVID basis, so we're talking about 1 million people a year, even if we add that back in, because of the slowdown in birth rates, we are still going to likely be on track for a decline in a decline of overall population starting in the year 2051. So as that starts to happen, one of the factors that's likely going to take place is the aging phenomenon that I mentioned. So here is a distribution of ages across the country and how we project them out. So as time goes on, as our population growth starts to flatten and then decline, and as birth rates start to fall as well, as I alluded to earlier, the number of people who are in that 30 and 40 and up category will be more than the number of people who are below that category. So again, older people, average age increases, average age of the labor pool increases, and retirements accelerate as well. We used to be in an economy where for every one retiree, we had 2 to 3 people available to backfill them coming into the workforce right behind them. That's eventually going to get to 1 to 1. Every one retiree may have one person coming in to fill them, and then eventually that ratio is going to decline as well. The right side shows you what we call dependency ratios. This is for every one worker out there, how many people are dependent on them? How many people look to them for their education, for food, shelter, money, etc.? In the year 1960, the dependency ratio is 0.75, meaning for every one worker, another 0.75 people looked to them for help. And of that, the vast majority of it was kids, youth, that maroon line, their own kids likely. And very few of it was that pink line, which is the age above them, the older generation. As time went on, that ratio came down, and now it's coming right back up, and it's arcing back up to 0.7. But the difference is those maroon and pink lines intersected last year. So what's slowly happening is that the amount of people, every one person still is going to have 0.7 people they have to care for, but it's likely going to be their own parents or their siblings or cousins or somebody in their age group or above them. That starts to change the nature of the kinds of products that are demanded in this country. So one takeaway from it is we're going to have fewer and fewer children. That starts to become a headwind for public education demand. Fewer kids going to school, fewer facilities needed for them. And we're starting to see that emerge in some pockets already, where demand for construction of some school facilities may start to change. Demand for construction for 55 and over residential communities may start to grow, on the other hand. And on the right side, one of the growth pockets we've identified is healthcare. I said earlier, healthcare makes up about 20% of GDP, made up 40% of economic growth last quarter. As individuals get older, they naturally demand more and more healthcare. And that's what these charts are showing you. Per capita spending on healthcare for somebody 85 and older is $35,000. Spending for someone 65 and older is $20,000. It starts to grow in a much more linear fashion as you get older. So if what I said is true, that America's average age is going to increase, so too is the average amount of money that needs to be deployed towards healthcare, which is why we've identified it as a growth area. Construction for hospitals, construction for retirement centers, construction and support infrastructure for in-home healthcare, all of it is where we see a lot of spending occurring over the next decade. As I alluded to earlier, because of the average age increasing, the types of homes might be changing. The right chart shows you household share by age, and we're getting to a point where there used to be a time where the average household, where the majority of homes in America were led by somebody under the age of 55. we're now getting close to an inflection point where the number of homes that are led by somebody over 55 is going to dominate. So going back to my point earlier about the types of homes that are likely going to be needed in the decades ahead as this phenomenon plays out. So now I'm going to get more granular about construction and what we're seeing play out here. So to start off with, let's break it down by residential and non-residential. Spending growth for residential construction is negative. So the dollar value is starting to contract. And this is a story we've been seeing play out for a bit now, where homes are still being built, residential structures are still coming online. It's just the growth rate is negative, and the dollars are less on an annualized basis than what they were 2-3 years ago. On the non-residential side, we were seeing significant growth in spending happening in 22, 23, and parts of 24. The growth rate has substantially come down there to 0% as well. That's all forms of non-residential. If I were to break this down, though, into data centers and other forms, data centers are what's keeping this number from going even further down. Office and retail growth spending has come down quite sharply. That's negative, and data centers is positive. That's 30%. So between those two, we're getting to this average of 0. Going back to my points earlier as to why the AI-focused construction verticals matter so much is because that's what's driving a lot of the non-residential spending that's happening right now. I'm going to go back to but let's just go a little bit deeper on residential for a second. So mortgage rates over the last couple of weeks have finally started to see some relief, but they're still elevated on a historical basis. The average mortgage, 30-year fixed mortgage rate was running at around 7.5%, came down to 7. Now it's dipping down below 7 into the upper 5s and lower 6s in some pockets. So mortgages have improved, but they're still much higher than what we saw when they were sub 3%, for example. So that causes a dampening effect on overall demand for residential construction. That's one part. That's what the tan area in this chart is showing you. The other important moving parts to look at is the maroon and the pink lines. The maroon is single family rental rates on a monthly basis, and the pink is new mortgage payments. So you can see for a number of years, and this used to be a traditional statement, for a number of years, mortgage payments were less than rental rates. And that was a big motivating factor for people to buy a home. And there are a lot of motivating factors to buy a home, but that was one of them, which is you can drop your monthly payment. Sure, you got to put down a down payment, but you're going to be spending less on your rent than you would otherwise if you were renting. So you might as well build equity and buy a home and all that kind of stuff. Following the rise in interest rates, when we were out of that 3% mortgage environment and moved to a 7.5% mortgage environment, you can see what happens to that pink line where it starts to move higher than the rental rate. So we're in an era now where the average monthly mortgage payment is the same, if not more, than the average monthly rental rate. This skews the dynamics of home purchasing because all of a sudden now, many consumers are going to say, well, why would I do that? Why would I put a down payment down, take this mortgage on, take these interest expense when I can just rent for the same amount of monthly maintenance? Because a lot of people think about their expenditures on a monthly basis. And so that's skewed the type of demand for housing. So that's driven up rental demand. And in particular, we saw a boom in multifamily construction activity on the back of it, and it all correlates. We do think some of that's going to continue. Housing supply in respect to how many homes are on the market, how many days they're on the market is starting to go back up again. And that's been happening for the last couple of quarters and months. Inventories have picked up. Days in the market for average home has increased. And this is all symbolic of that slowing housing market. Some of it, again, is influenced by the high mortgages. Some of it's influenced by the fact that people may just prefer to rent in this environment rather than buy. But some of it's also influenced by the lack of mobility. And one of the things that we've picked up on and we track really closely is this unintended consequence that came out of the massive volatility in interest rates. So when we often say that most of the homes bought in this country were purchased during that low interest rate environment, when the average fixed mortgage rate was like 3%, 2.7%, et cetera. When we did our calculations, we found that the average mortgage paid in this country today is still 3.5%. That's because most Americans bought their homes in that 0% mortgage or the 0% Fed funds rate environment. So they're locked into it. So if you're an individual who's got that 3.5% mortgage, you're not really incentivized in this moment of time to sell your home, buy a new home, and take on a 7% mortgage because you'd have to downsize massively. So what that did is that depleted the availability of existing homes. And that's what this chart is showing you. So the tan area shows you existing home sales volumes. Maroon shaded area shows you new home sales volumes. And you can see that right when interest rates started to rise and right when that 30-year fixed mortgage got to 7-ish%, the transactions of existing homes came down really quite sharply. But it was really driven by the lack of supply. And then the new construction market also pulled back on the back of it. That's why this orange and pink line shot up. That's why prices of homes went up quite so sharply. It's because even as the market slowed theoretically from a transactions perspective, it was really driven by a depletion of inventory. That was the first part of the equation. So prices went up. Today, even though transaction volumes are below their 2020, 21, even pre-2020 cycle, prices have not really fallen apart. Prices continue to hold up. So just to summarize what we saw, transaction volumes came down, largely driven by a lack of inventory. That drove up prices. It goes back to my home equity comment about how that led to this wealth effect and people feel that they have money. Now prices aren't really rising, so the growth in new and existing home prices has pretty much flatlined. It's running at around 0%. It's not negative, so that's the good news. But we're also not seeing that significant accretion in prices that we saw during the prior time period. And this just shows you, again, what I was talking about earlier, the flip from buying a single family home to a rental unit. This has driven overall construction activity for single family homes to slow, whereas multifamily construction growth and starts, as we call it, is growing. And so this just shows the flip that's taking place from single to multifamily. There's still a lot of single family homes being built. It's just the growth rate at this moment in time is still concentrated in the multifamily segment. Builder confidence is still quite weak when we look back to what was happening in 21 and 22. This is the builder confidence, the National Association of Home Builders Confidence Index that we look at. 21, 22, it was at the 90s and 80s, which implies very, very positive. As soon as this number dips below 50, it implies net negativity or pessimism. And we've been in this pessimistic era. One of the reasons is that even though Fed funds rates have come down, you haven't seen the translation significantly to an improvement in mortgages. So transaction volumes are still down. And going back to the chart I just showed you about housing starts being weak, builders are pulling back and they're showing some signs of concern about the housing market. It's not falling apart. This is not 08 at all. We're just saying that the growth in pricing, the growth in spending, in CapEx, in starts, it's all just kind of flattening right now. And when we take a longer view of what's going to be needed for the residential side, there used to be a statement often made that America needs 1.5 million new homes a year. And that's a statement that was often thrown out there. When we look back in time, it held. If we look at the late 90s, about 1.5 million homes were being built on average throughout the year, which met with demand. When we go to the early 2000s, pre-global financial crisis, there was an overbuilding boom because of the valuations. So we perhaps built too much. In the post-GFC environment, there was an underbuilding, and that carried right up until 2015, 2016, where demand was growing, but there probably wasn't enough inventory, creating some pressures for pricing. When we look at 2016, 2020, right before COVID, the economy was back, the housing market was back in balance between what was being built and what was demanded. During COVID, to reduce the shortage, builders overbuilt, and now we're seeing a pullback in some of that. And our expectations are that housing is obviously still going to be needed. We are still adding humans to this country. People are going to be mobile. They want to move into new homes, new structures, etc. All we're saying is that when we look out to the next decade, we likely won't need 1.5 million homes a year. It may be more like 1.3 million homes a year. So it's not falling apart, but it's just that the traditional statement may have to be adjusted slightly as we look to the future between what I said about the demographic story, the types of housing needed, and the cost of housing, the affordability element, may just pull back the longer term run rate of the number of homes needed on a given basis. On the non-res side, going back to some of the comments, and I alluded to about the AI equation, here's the chart on data center construction. As I mentioned, spending on data centers was growing 90% a year. Now it's growing by 30% a year. Still a huge number. So there's still a lot of capital expenditure being deployed to build these data centers, and we do expect that to continue into 2026. On the flip side, these are the areas I was mentioning earlier that are dragging the overall non-res spending to zero. General office construction is negative, so there's less and less spending happening on office units. And warehouse construction is also negative. The amount of annualized dollar spending there is below its peak. The office one, I think, is a little obvious as to why that's likely happening. The warehousing side, we believe, is a combination of a shifting of demand away from goods, as we saw post-COVID when people wanted to go out and travel more. And more recently, we believe it's a byproduct of tariffs. Reorientation of trade. Our trade deficit is narrowing quite a bit. It has been over the last couple of quarters. After the first quarter, when I said we had a massive trade deficit, which dragged the economy down, since then it's been normalizing a bit. That's depleting the demand for some of the warehouse construction activity. When we get to the cost element, going back to the comments about inflation, construction material component costs and raw material costs, during COVID, in line with the overall increase in inflation, building material costs rose quite a bit. Construction component prices were rising 30% year on year. Raw materials were rising 25% year on year. That number has since come down. But I'm going to reiterate what I said during COVID. When I said during earlier in my comments, which is that overall inflation for construction material has come down as a percentage rate of change. It's running at around 4 to 5% now for components at least, but that doesn't negate the buildup in prices that accrued over the last 5 years. So yes, things cost more than they did in 2019. It's just the rate of change isn't what we saw at its worst. It's rising by 4% a year now. And when we look at raw material prices, these are commodities. These are less. Some of this is affected by trade policy, but commodities that are driven by an assortment of factors. Overall increase in raw material prices for inflationary pressures has also started to come down. So same statement. The year-on-year rate of change has come down, but the overall cost still is more. Sheetrock, drywall, et cetera, does cost more than it did 5 years ago. And that part's not going to go negative. It's not going to come back down to 2019 prices. So one end of when we think about cost of construction, we think about the materials, which I spoke to, but then the other element is wages, labor availability, the cost of the human capital part. One of the big stories in 2025 was immigration policy. So what this chart here is showing you is a percentage or where undocumented workers are heavily concentrated. And I don't think this chart should be surprising. And I'm pointing this out though, because undocumented workers, there's 3 or 4 industries that absorb them quite a bit. Construction is one, agriculture is another, restaurants is a third. And so the construction vertical inevitably will get affected by the availability of undocumented workers, which we are seeing declines of. Now, overall construction market, the headline official number says that there's about 8 million workers in the construction sectors across the board. That number really hasn't changed. It's still 8 million. But again, that's the official number. It does not account for the undocumented portion, which may have left the workforce and left the country. When we look at jobs filled, what we're finding is that there's a slowing occurring. So people aren't really getting laid off in the construction sector, but there's not a lot of additions happening either. So what we refer to this as a low turnover market. And what our thesis is that a lot of construction companies, we think, are holding on to labor. Even if they don't yet have the projects for them, they believe that the projects are going to come through, and they don't want to be caught in a situation where they bid on a project, they start a project, and they can't find the labor. And we think some of those pressures may be exacerbated by what I just said about the unavailability of undocumented workers in parts of this country. So we think that businesses in the construction area are holding on to labor, and that's what's causing some of the turnovers to flatten, and they just keep paying them. What that's also doing, or what that was doing, which is what you see on the right side, is it was putting some pressures into construction sector wages. And we were seeing that for a while, where construction sector wages were growing at a faster rate than all wages. And that's, again, because of the labor dynamics, the unavailability of labor, the desire for companies to hold on to labor and continue to pay them. So wage pressures were building up. But what's interesting is now it's starting to normalize. So I cited earlier, it should be 3.8%, the all industry wages, not 3.5%. So overall wages across all sectors, all ages, all parts of the country are rising by 3.8%. For the construction sector, it's now 3.6%. So it's dipped slightly. So we're starting to see wage pressure buildups below the national average, but 3.6% is still a big number. So in other words, the construction sector is paying out 3.6% higher and higher in wages in every single year. So collectively, my view on this is that on the good side, which is what this chart is showing you, we're probably going to see a little bit more inflation pressures build. And we look at this from an input-output perspective. The input cost for GCs and goes in the construction side is on the left side. Their pressures have been rising by 3.5%, but yet on the output side, they're only passing around 0.9% inflation. So said another way, the cost of doing business for a lot in the construction sector from the good side is rising. Material costs, again, went up. It's all there. They're not fully passing it along. So we think some of that may start to get passed along. And then just to close out, on the wages side, the labor side, as I mentioned, we do think some of those pressures are still building. So overall cost of construction is not what we were seeing during 2021, 22, but it's still above trend from what we were seeing before COVID. Okay, so I'm going to stop there. And I'm going to hand it back to you. And if I'm happy to answer some questions.
Okay, excellent. Thank you. The first question, are you able to link the deck in the comments?
I don't think I can do that. So it's going
I
to be
don't
hard.
think we can do that, but we can send the slide deck out and we will have it available with the recorded presentation. So does anyone else have any questions? If you do, go ahead and type those in the chat box. And while we are waiting for those, again, Shailesh, thank you for your presentation and thank you for everyone joining us today. Again, this presentation will be available. We'll get it uploaded today and have it on the ASA online website. Okay, we do have a question. When looking at the GDP growth, does that account for inflation? What is the delta of true growth and output as a country?
Yeah, it does. Anytime and us or anyone for that matter talks about inflation, we cite what's called the real number, the real inflation number. So real growth number, you deflate it by inflation. So there's something called nominal and there's something called real. So to give you an example, if nominal GDP growth was 10% and inflation was 5%, real GDP growth would be 5% because you discount it. And that's what we do. That's what everyone does. So all those numbers I cited at 4.3%, Q3 GDP growth is net of inflation.
Okay, thank you. Does anyone else have any questions? Shailesh, I'm not seeing anything come in right now. So I think you may have answered everything.
Perfect. All right. Well, okay. Thanks for having me again. Appreciate it.
Again, thank you for joining us and thank you everyone for jumping on and we look forward to you on our next ASA webinar.
Great. Speak soon.
Thanks. Goodbye.